Welcome to the deep dive. Today we're looking at something that traditional economics often overlooks, how real human behavior consistently strays from those, perfectly rational models.
Right, the ones you might have learned about.
Exactly. Those scenarios where people always make the choice that maximizes their benefit, weighing every option with cool logic.
Yeah, but our sources today show that's rarely the full story.
So, our mission in this deep dive is to uncover the surprising and sometimes seemingly illogical ways we actually make decisions.
Hmm.
And you've likely seen this in your own life, right? Where your gut feeling, or maybe just a fleeting emotion, nudged you in a direction that pure logic might have questioned.
Absolutely. Standard economic theory often envisions us as these hyper-rational beings, econs, as some people call them.
Right, econs.
But the research we've gathered highlights these fascinating instances of what we might call misbehaving.
Misbehaving, I like that.
Yeah, where our actual choices just diverge from what those models predict.
Yeah.
And understanding these deviations isn't just, academically interesting.
No, it gives you real insights.
It really does. Profound insights into the psychology that underlies our everyday actions.
Okay, let's unpack this with a great example. When I was teaching, I actually started grading exams with a total of 137 possible points.
This is the usual 100 leather.
Yeah, instead of 100. Now, the way the final percentage grade was calculated didn't change at all. Nothing changed there.
Okay.
But the effect on how happy the students seemed was, oh, well, it was incredible.
Ah, that's intriguing. So it's how those nominal numbers influence their perception.
Exactly.
By increasing the total points, you essentially achieved two things psychologically, didn't you?
I think so. What were they?
Well, first, the average numerical score jumped up, often into the 90s.
Right.
Which almost certainly felt better initially, just seeing a number in the 90s.
Yeah.
And second, it probably made it maybe a bit harder for students to immediately figure out their actual percentage grade.
Exactly. Getting a 96 out of 137 just felt so much better than, say, a 70 out of 100.
Even though they're the same grade.
Even though they represent the exact same grade. And here's a funny thing. I even started putting a note in the syllabus, in bold, explaining it.
Explaining the system.
And yeah, saying, look, the 137-point system is designed to make you happier without affecting your real grade. And guess what?
What happened?
Suddenly, no more complaints about the exams being too difficult.
Wow. So if we connect this to the bigger picture, it really underscores how sensitive we are to the face value of numbers.
Yeah.
Even when they don't really reflect the underlying economic reality. The students reacted to the larger number, the 96.
Focusing on that.
Focusing on that rather than the ultimate outcome, their grade.
Yeah.
It's a clear example of how our processing of information isn't always perfectly rational.
So the key insight there is really about framing, how it's presented.
Definitely. How information is presented can significantly impact perception and emotional response, even when the underlying facts are exactly the same.
Okay, here's where it gets really interesting for me. Another area where traditional economic thinking kind of bumps up against how we really behave is in how we value things. Even something as fundamental as, well, the value of a human life.
Right.
Inspired by Thomas Schelling's work, I tried to figure out, how much extra pay people would demand to take on jobs with a higher risk of death.
That's a classic area of economic inquiry, isn't it? Trying to put a number on these non-monetary costs and benefits.
It is.
Schelling's work looked at this concept as statistical lives and the compensation people implicitly require for increased risk.
Yeah, but I ran into some problems finding the data.
Oh, like what?
Well, getting reliable statistics on mortality rates for different occupations turned out to be surprisingly tricky, just hard to find good numbers.
I can imagine.
That's where my dad, Alan, stepped in. He was an actuary.
Ah, okay. So risk assessment is his bread and butter.
Exactly. One of those people who are experts in assessing and managing risk for insurance companies. And he managed to find this publication
From where?
from the Society of Actuaries that had precisely the data I was looking for.
Okay, so you had the mortality rates. What was the plan then?
The idea was to link these detailed mortality rates across various jobs with the corresponding wage data
Right.
to try and estimate that unspoken value people place on the added risk.
So it's about looking beyond just the paycheck.
Exactly. It's about looking beyond the simple monetary transaction of a wage to understand the less obvious costs and values that influence people's decisions, even if they aren't consciously calculating them.
It shows our considerations often extend beyond just pure financial gain or loss.
Which kind of brings up an important question, doesn't it?
Yeah.
How do our biases and emotional attachments affect how we value things?
Absolutely. And a perfect illustration of this is the endowment effect.
Oh, the endowment effect. Yeah, this one always surprises people. Imagine this scenario.
Okay.
Dean, an MBA student, good financial prospects ahead of him.
Right.
And his friend, a divinity school student, who's definitely on a tighter budget.
Okay, got it. Different financial situations.
And they both receive free tickets to a big basketball game. Like, really good seats.
Same free tickets for both.
Yep, identical. But their decisions were quite different.
How so?
The divinity student was, thrilled, couldn't wait to go to the game.
Okay, makes sense. Free game.
But Dean, he saw an opportunity and sold his tickets for a significant sum of money. Like hundreds of dollars.
So one goes, one sells.
And the funny part is, they both thought the other person was being completely unreasonable.
Really? Why?
Dean couldn't understand why his friend would waste such valuable tickets by just going.
Okay.
While his friend couldn't grasp why Dean wouldn't just enjoy a free, amazing game.
That mutual bewilderment that perfectly captures the essence of the endowment effect, doesn't it?
It really does.
It's this tendency to value something we already possess much more highly than something we don't.
Even if they're objectively the same.
Even if objectively they have the same market value. Once Dean had those free tickets in his hand, poof, they became something he valued at his selling price.
And his friend.
His friend, having already mentally pictured himself at the game, maybe, valued the experience more than the potential cash.
So the key insight here is, we might be overvaluing things just because we own them.
That's it, which could lead to missed opportunities to sell or trade things maybe we should.
So these aren't deliberate, rational calculations we're talking about, are they? It seems like our brains use these automatic shortcuts. These rules of thumb we're not even really aware of.
Exactly, because our brain power is limited, right? We can't analyze everything perfectly.
So we take shortcuts.
We often rely on these simple rules or heuristics to make judgments quickly. A classic example is the availability heuristic.
Availability. How easily something comes to mind.
Precisely. Let me ask you, how common do you think the name Droove is?
Drooves. My gut feeling is not very common. At least not where I live.
Right, that's the key.
Mm-hmm.
But in reality, while it might not be common in, say, North America or Europe, it's actually a very frequent name in India, which has, a massive population.
Oh, okay. So globally.
Globally, it's quite common. Our judgment is often based on how easily we can recall examples, how available the name is in our memory, like you said.
That makes sense. If you don't personally know anyone named Droove, it's easy to assume it's rare.
But, as you pointed out, how easily something comes to mind doesn't always reflect its actual frequency in the world.
Okay.
And the crucial insight here, the one that really challenged traditional economics, is that using these heuristics can systematically lead to predictable errors.
Predictable errors. Biases.
Exactly. Biases in our judgments. Herbert Simon was a key early thinker in this area, sort of setting the stage for the groundbreaking work by Daniel Kahneman and Amos Tversky on these heuristics and biases.
Which brings us to another fascinating area. How we make decisions when things are uncertain.
All right, risky choices.
Traditional economic theory, going back to Daniel Bernoulli. It focused on how our happiness or utility changes with different levels of wealth.
The idea of diminishing sensitivity.
Yeah, that the impact of an extra dollar decreases the richer you are. That makes intuitive sense, right?
Sure. $1,000 is a huge deal to someone struggling, but maybe less so to a millionaire.
Exactly.
Bernoulli's model was an important step, especially for understanding why people tend to avoid risk. But Kahneman and Tversky came along and offered a fundamentally different perspective.
Oh, so?
They realized that to truly understand how we make decisions, we need to look at changes in our wealth relative to a reference point.
Not just the absolute levels.
Not just absolute levels of wealth. It's about the gains and losses from where we are now or where we expect to be.
That sounds like a subtle shift, but the implications are huge, aren't they? It's not just about how much you have, but whether you're gaining or losing compared to, your starting point.
Precisely. Think about the temperature in a room. Yep. If this room is the same temperature as your office back home, you probably wouldn't even notice it.
Right, feels normal.
You only react if it's significantly hotter or colder than what you're used to. We adapt, and it's the changes that grab our attention and drive our responses.
This idea of reacting to changes rather than absolute levels, it's perfectly illustrated by that classic jacket and calculator problem, isn't
Oh,
it?
yeah, that's a great one. Tell us about it.
Okay, imagine you're about to buy two things. A jacket for $125 and a calculator for $15.
Got it.
Then you find out the calculator's on sale for $10, but it's at another store, a 20-minute drive away.
Okay, so say $5 on the calculator.
Right. Would you make the trip? Now, same scenario, different prices. The jacket costs $15 and the calculator costs $125.
Okay, flip.
And the calculator is on sale for $120 at that other branch. Same $5 savings, same 20-minute drive.
So what do most people say? Which trip are they more likely to make?
Well, the common response is that people are much more willing to drive the 20 minutes to save $5 on the $15 calculator.
Than on the $125 one.
Yeah, much more willing, even though the absolute saving is the same, $5, and the effort required is exactly the same.
Which highlights that our decisions are often based on relative changes, not absolute values. Saving $5 feels bigger when the item is cheap.
Exactly. It's the relative saving that seems to matter. Saving $5 on a $15 item feels like a much bigger deal, like a better bargain.
Than saving the same $5 on a $125 item.
Right. This really shows how the way a decision is framed, are we thinking about the percentage saved, maybe, significantly influences our choices.
Another instance where we misbehave
Yeah.
according to purely rational economic principles.
It ties directly back to prospect theory, right? Evaluating gains and losses relative to that reference point.
Exactly. Saving $5 on $15 feels like a larger gain relative to the original price than saving $5 on $125.
This actually leads us into a fascinating historical debate about the very foundations of economic theory.
Oh, yeah.
Richard Lester, back in the day, did a survey of businessmen that challenged the conventional marginal theory.
Right. The idea that firms make decisions based on marginal costs and marginal revenues.
Yeah. Lester basically asked business leaders how they made decisions, like pricing or investment. And their answers didn't really sound like they were constantly calculating these marginal costs and benefits in the way the theory suggested.
So that caused a bit of a stir.
It caused quite a stir in the economics world at the time.
And who defended the traditional theory?
That was Fritz McClelp. He argued that economists aren't really concerned with what people say they're doing, but rather with their observed behavior.
The as-if argument.
Sort of. He used the analogy of a driver overtaking a truck. They don't do complex physics calculations.
Right, they just kind of feel it out.
Yeah, but their action roughly aligns with what a rational calculation would recommend. He suggested executives operate on a similar intuitive feel for the situation.
But McClelp was quite critical of Lester's survey evidence, wasn't he? Did he offer his own data?
No, that's the interesting part. He criticized Lester's data heavily, but didn't really provide his own empirical evidence to back up his counter-arguments.
It's interesting how Milton Friedman's later work on the methodology of economics also fits into this broader discussion about what counts as valid evidence.
Definitely. Friedman's as-if principle became very influential. The idea that as long as people's behavior acts as if they are rationally maximizing, the theory holds, regardless of their actual thought processes.
But that wasn't enough to dismiss the behavioral findings.
Well, by the 1980s, simply relying on this as-if argument wasn't really cutting it anymore, especially with the growing body of evidence showing systematic deviations from rationality and actual choices.
There was a clear need for data demonstrating these misbehaviors in real decisions, not just surveys.
Exactly. You can see why economists might be skeptical of evidence based solely on surveys, what people say they do and what they actually do.
Can be two very different things. Which brings us to the role of incentives.
Right. Traditional economics places a huge emphasis on incentives. The argument is, when the stakes are high, people will think more carefully, make better decisions.
But Kahneman and Tversky's experiments often involved very small stakes, or even no financial incentives at all.
And that was a major criticism, wasn't it?
It was a major point of criticism from some economists. They argued, well, these findings might not apply when real money is on the line. People won't be irrational if it costs them.
The assumption was that if you just raise the stakes enough, these weird behaviors would disappear.
That was the prevailing assumption, yeah. But it was largely based on intuition rather than, solid evidence.
And basic economic theory itself doesn't say it only applies when the stakes are high, does it?
Not at all. The decision to buy a cup of coffee should, in principle, be governed by the same underlying rational principles as the decision to buy a house.
So it should apply across the board.
It should. And actually, Early research by economists at Caltech began to challenge this specific notion that higher stakes automatically lead to perfect rationality.
Hmm.
They weren't finding that errors just vanished with bigger incentives.
So the idea that more money on the line magically makes us perfectly rational just wasn't supported by the evidence.
Not really. And then there's the learning argument.
Ah, yes, the idea that people learn from experience.
Right. Economists often pointed out that lab experiments are typically one-shot events, while in the real world, we have repeated opportunities to learn from our mistakes.
Like learning to drive.
Exactly. You're not very skilled at first, but with practice and feedback like narrowly avoiding an accident, you improve significantly. The argument was that the errors we see in the lab might just be people who haven't learned yet.
Okay, so maybe these biases disappear in the real world with experience.
Well, while the concept of learning is certainly important, the crucial point is that effective learning requires practice and timely feedback.
Right, you need to know if you made a mistake and why.
Exactly. And many of the most significant life decisions, choosing a home, a mortgage, a career path, planning for retirement.
Those are things you don't do very often.
Precisely. They're infrequent events. We don't get multiple chances to practice buying a house or choosing a 40-year career path and get immediate feedback on whether it was the optimal choice.
That's a great point. You don't exactly get to try out a few different mortgages to see which one works best over 30 years.
Exactly. So in fact, you could argue that as the stakes get higher and the opportunities for learning decrease, the quality of our decision-making might actually decline.
Because of stress or pressure.
Yeah, maybe due to increased stress and pressure and just lack of practice. So the critique that lab findings are invalid because of a lack of learning doesn't always hold up for these big, important decisions.
Okay, so we're not perfectly rational. Our decisions are influenced by framing. We react more to changes, and learning is limited for many big life choices. Now, let's delve into this idea of mental accounting. What exactly is it?
Mental accounting describes the way we sort of categorize and treat different sums of money or different financial activities in our minds.
As opposed to just seeing all money as the same.
Right. Standard economic theory suggests that money is fungible, a dollar is a dollar, regardless of where it came from or what it's intended for. The key concept is opportunity cost.
What you give up to get something else.
Exactly. The real cost of any choice is what you have to give up to make that choice. For instance, if you have that basketball ticket you could sell for $1,000. The true cost of attending the game is that $1,000 you forego, no matter how much you originally paid for the ticket, even if it was free.
So, in a perfectly rational world, you'd only go to the game if the enjoyment you expect is worth more than the $1,000 you could have had instead.
Precisely. But mental accounting violates this fungibility principle. We don't always see our money as one big interchangeable pool.
We put it in different boxes in our heads.
Kind of. We create these mental categories or silos and apply different rules and maybe different levels of scrutiny to the money within each category, like vacation money versus bill money.
This definitely explains why a good deal can sometimes lead us to buy things we wouldn't normally consider.
Oh, absolutely.
That deeply discounted sweater that ends up gathering dust in the closet is a perfect example of the psychology of deals, right?
Exactly. Sellers know this very well and use it constantly. The allure of getting a significant discount can be incredibly powerful.
It feels good.
It does. It sometimes overrides our actual need for the item or even its intrinsic value. And this is largely why everyday low pricing strategies often struggle.
Compared to having lots of sales.
Yeah, compared to the excitement generated by frequent sales and discounts, people enjoy the feeling of getting a bargain, the thrill of the hunt, maybe.
Even if they end up buying things they don't truly need.
Right. We've all experienced that rush, haven't we? Getting a great deal, even if it's on something we might later think, why did I buy that?
It's almost like a separate mental reward system kicks in just for snagging the deal itself.
Retailers have certainly learned this lesson the hard way sometimes. Remember when Macy's and JCPenney tried to move away from constant coupons and sales?
Vaguely, yeah. How did that go?
Not well. Their customers reacted really strongly, negatively. Sales plummeted. The perceived loss of those deals had a huge impact on consumer behavior.
So the key takeaway for businesses is framing matters a lot.
Absolutely. The framing of a purchase as a deal can significantly influence its appeal, even if the actual price reduction ends up being the same as an everyday low price model over time.
So our mental accounting can lead us to focus on the perceived gain from the discount rather than the overall opportunity cost of spending that money in the first place. Now, what about sunk costs? How do they fit into this mental accounting framework?
Sunk costs. These are costs that have already been incurred and cannot be recovered. You've already spent the money or the time.
Okay. And rationally, they shouldn't matter for future decisions.
Rationally, no, they're gone. They should be irrelevant to future decisions about whether to continue a project or finish a meal or whatever. But
And we find it really hard to ignore them.
we often find it very difficult. We might force ourselves to finish a terrible meal at an expensive restaurant simply because we've already paid for it.
Or keep pouring money into a failing project.
Yes, that feeling of, I've already invested this much time, money, I can't give up now, even when it's objectively clear that continuing is the less optimal path. That's the sunk cost fallacy in action.
And sometimes sunk costs and opportunity costs get tangled up.
They can become intertwined in our mental calculations, making the decision-making process even more complicated. I worked with Eldar Shafir on some cases looking exactly at that.
You mentioned budgeting earlier in relation to mental accounting. How do budgets play into these seemingly illogical outcomes?
Well, budgets, whether in big organizations or just our personal households, serve a really vital purpose, right? They help control spending, provide structure.
Sure, makes sense.
However, they can also lead to these somewhat inefficient outcomes because of mental accounting. Imagine a situation in a company
Okay.
where one department urgently needs funds for a critical repair. Maybe something broke unexpectedly, but all the readily available cash is strictly allocated to a different budget category, maybe for marketing, that doesn't have immediate needs right now.
So the money exists, but it's in the wrong mental box.
Exactly. The money isn't freely transferable within the companies or our own mental accounting systems, even if, logically, it should be moved to where it's needed most.
The labels we put on money really matter.
They really do. We create these mental silos, and it can be surprisingly difficult to move resources between them, even when it would clearly be the most beneficial thing to do.
Is there research showing this?
Yeah, there was a study by Hastings and Shapiro on gasoline consumption after a big price drop.
What did they find?
They found that families who seemed to have a separate mental gas budget were more likely to use the savings from the lower gas price to buy premium gasoline.
Instead of using that, save money for other things.
Exactly. Instead of shifting those funds to other household needs like milk or orange juice, it suggested they were keeping that gas money mentally separate.
That's a fascinating example. So budgeting, while helpful, can sometimes create these artificial constraints on how we use our resources.
It can. And you also touched on how we traditionally view different types of savings, like home equity. How did that fit into mental accounting?
Well, historically, certainly in the U.S., home equity was often viewed as a very secure, almost untouchable form of savings. Like, it was separate.
Right. There was a strong cultural emphasis on paying off mortgages as quickly as possible, building up that equity.
But that perception shifted.
It began to shift,
Yeah.
partly due to an unintended consequence of tax reforms back in the Reagan era.
How so?
Those reforms made home mortgage interest basically the only form of consumer interest that remained tax deductible.
Ah, okay. So it created an incentive.
It created a big financial incentive for people to take out home equity lines of credit, or ELUCs. It effectively made it easier and tax-advantaged to tap into that previously sacred savings account.
So a seemingly unrelated policy shift subtly changed our mental categorization of our home equity.
Pretty much. It shows how policy changes can subtly alter our mental accounting of assets and influence behavior in ways maybe nobody predicted.
It's amazing how these subtle external factors can shape our internal financial behaviors. Okay, let's switch gears a bit and talk about another crucial area where traditional economics often falls short: problems of self-control.
Right. The struggle between what we want now and what's good for us later.
Have economists always just ignored this aspect of human behavior? Assumed we always act in our long-term best interest?
Interestingly, no, not at all. For a couple of centuries, actually, economists who wrote on the subject were acutely aware of our struggles with self-control.
Really? Like who?
Well, Adam Smith himself,
Yeah,
often considered the father of modern economics.
the invisible hand guy.
Yeah, him. While most people associate him with the invisible hand concept in The Wealth of Nations, he also extensively discussed the internal conflict we all feel between our immediate passions and desires and our more rational long-term perspective, which he called the impartial spectator.
Huh. I didn't realize that was in Wealth of Nations.
It's easy to forget it's a massive, complex work covering a huge range of topics,
Sure.
not just that one famous metaphor.
Right.
And even Smith's phrasing around the invisible hand itself, noting that the pursuit of private gain is led by an invisible hand to promote an end which was no part of his intention, has a certain degree of nuance that's often overlooked.
He wasn't saying it always works out perfectly.
Not necessarily. He noted that the pursuit of personal profit can lead to benefits for society, but his language, nor is it always the worse for society that it was no part of it, is quite cautious. It's hardly a blanket endorsement of completely unregulated markets in all situations.
So the idea that we have self-control issues isn't some new discovery in economics. What happened? Why did the focus shift away from this more nuanced view?
Well, the field of economics gradually moved towards more formalized mathematical models, and Paul Samuelson's model of discounting future consumption became the standard.
What was that model?
It basically assumes we discount future consumption at a steady, constant rate. It was elegant, mathematically tractable, relatively simple to work with.
So the idea is if a benefit a year from now is only valued at, say, 90% of the same benefit today,
Then you're discounting the future at a rate of 10% per year, and you'd apply that same logic consistently further out.
this steady discounting model seems very clean and, well, rational. What are its limitations when it comes to reflecting how people actually behave?
Well, Samuelson himself, when he proposed it, acknowledged that his model had serious limitations.
He did. What limitations?
One crucial point he raised was that if people's discount rates aren't constant over time,
If they change.
yeah, if we value immediate rewards much, much more than slightly delayed rewards, but then our evaluation of more distant rewards is more stable relative to each other, well, then our behavior might become time inconsistent.
Time inconsistent.
Meaning we might change our minds as time passes, even if our fundamental preferences haven't actually changed. What we want now might conflict with what we plan for the future.
Ah, okay. That sounds familiar, like wanting to save money for retirement, but also wanting that new gadget right now.
Precisely. Think about Matthew, who might initially prefer, say, a slightly better dinner in 3 months over a good dinner this week.
Okay.
And maybe the best dinner in a year over the one in 3 months. That sounds rational.
Right. Planning ahead.
But as this week arrives, the immediate gratification of the good dinner now might suddenly become much more appealing, and he chooses it.
Okay, he gives in.
Then, maybe as 3 months approaches, he might then favor that option over the one still a year away. His preferences shift as the options get closer in time.
So his choices aren't consistent over time.
Exactly. His preferences are inconsistent. There's an analogy sometimes used from a New Yorker cartoon,
Yeah.
showing someone looking through a telescope and seeing different distances depending on which end they look through. The perceived value of future rewards changes dramatically as they get closer.
So the key takeaway is our preferences for future rewards aren't always stable.
Right. Which can lead to impulsive decisions that we might later regret.
So we have this internal tug of war between our present desires and our long-term goals. How do we try to manage these self-control problems?
Right. People develop all sorts of strategies, consciously or unconsciously. The story of Odysseus and the Sirens is a classic illustration.
Right, the deadly singing ladies on the rocks.
Exactly. Odysseus knew he wouldn't be able to resist their fatal song if he heard it clearly. So he used 2 strategies.
Whoa, were they?
First, he had his crew plug their ears with wax. That's removing the tempting cue, right?
Yeah.
They couldn't hear the song.
Okay, avoid the temptation.
Second, for himself, because he wanted to hear the song but not die, he had his crew tie him tightly to the mast of the ship.
A commitment device.
A commitment device, exactly. He restricted his future choices so he couldn't steer the ship towards the Sirens, even when he desperately wanted to.
Removing temptation and using binding commitments, those seem like powerful self-control mechanisms.
They are. Either we try to avoid the cues that trigger the unwanted behavior, or we restrict our future choices to prevent ourselves from acting impulsively when we know we'll be tempted.
Are there modern examples?
Sure. The economist Harry Strauss apparently used a personal commitment strategy with his own salary payments.
Oh, so?
He chose to receive his university salary in 12 monthly installments, rather than a larger lump sum over the 9-month academic year.
Even though he could have potentially earned more interest on the lump sum.
Right. Presumably, he did it to help manage his spending throughout the year, a form of self-imposed budgeting or commitment.
It sounds like you were trying to create a more formal economic framework for understanding these self-control issues back then. How was that initial effort received?
With a fair amount of skepticism, to be honest.
Yeah.
It felt a bit like being in academic no man's land for a while.
Why?
Well, many traditional economists viewed it as too psychological, maybe lacking mathematical rigor.
Okay.
while some psychologists perhaps saw it as just rediscovering things they already knew about willpower and temptation, just maybe putting it in different terms.
And nobody was thinking about Adam Smith back then.
Interestingly, no. At the time, few economists were really aware of Adam Smith's earlier, quite insightful work on self-command and the internal struggle. That came later.
So you needed a way to make these ideas more robust, integrate them more firmly within established economic thinking.
Exactly. That's where my collaboration with Hersh Shefrin became so important.
Who was he?
Hersh was a brilliant mathematical economist. And crucially, he was open-minded enough not to just dismiss my initial, perhaps less formal ideas out of hand.
So you complemented each other.
We did. We had very different personalities and approaches, but we worked really well together. We spent countless hours in discussion, probably much like Amos and Danny did, just wrestling with these concepts.
Trying to model this internal conflict.
Yeah. We eventually developed a model based on the idea that we have sort of two selves inside us. A planner, our more rational, forward-looking, long-term self.
Okay, the sensible one.
And a doer, our more impulsive, short-term oriented self that just wants gratification now.
Right, the one that eats the cookie.
Exactly. And the tension, the conflict between these two internal agents drives many of our self-control problems and explains things like procrastination or failing to save.
That's a really intuitive way to think about it, like having two different parts of ourselves with potentially conflicting goals. Now, let's loop back to marketing for a moment. You mentioned car rebates earlier. How do they connect to this mental accounting stuff?
Right. Car companies figured out, probably through trial and error, that offering a cash rebate often feels more appealing to consumers than an equivalent reduction in the overall sticker price of the car.
Even if the final cost is the same.
Even if the final out-of-pocket expense is exactly the same. The rebate is often mentally accounted for separately.
Like found money.
Yeah, almost like a bonus or an unexpected gain, which seems to intensify its perceived value and attractiveness.
So the key insight for businesses there is, again, framing.
Definitely. The framing of price reductions can significantly impact consumer perception and purchase decisions. A rebate feels different than just a lower price.
It's like getting a little bit of money back after the purchase, which psychologically feels maybe better than just paying less initially.
Exactly. And this mental accounting can sometimes even have these counterintuitive consequences. In some places, sales tax used to be calculated on the price before the rebate was applied.
Seriously. So people were paying tax on money they're about to get back.
Yep. Our minds are definitely wired in interesting ways.
They certainly are. Now, your collaboration with Daniel Kahneman was obviously a huge turning point. How did that relationship really develop after your time at Stanford?
Well, after our time together there, Amos and Danny both moved to universities in North America, Danny to UBC in Vancouver, Amos to Stanford later, and they continued their incredibly productive partnership.
Right.
Because we were all starting new academic positions around the same time and navigating similar career stages,
Right.
it just naturally led to more frequent interactions. And that was the beginning of a really influential and rewarding working relationship, especially with Danny.
And this collaboration, alongside the work you were already doing, helped uncover even more of these systematic misbehaviors. One particularly striking area is the research on how we judge fairness, right?
Yes, fairness is a big one.
The snow shovel experiment is a classic example of this.
It is. We presented people with a really simple scenario. A local hardware store normally sells snow shovels for $15.
Okay.
Then, the morning after a major blizzard hits the town, the store raises the price to $20.
Standard supply and demand, maybe? High demand, same supply.
From a purely traditional economic perspective, maybe. But we asked people to rate this action. Fair or unfair?
And the result?
The overwhelming majority, something like 82%, judged it to be unfair. Highly unfair.
Wow. So the key insight there is fairness isn't just about the price matching supply and demand.
Not at all.
Right.
It's deeply rooted in our perceptions of intent and context. Businesses that ignore this risk really alienating their customers, even if their pricing seems economically rational on paper.
Even though, like I said, from a basic supply and demand view, it might seem like a logical market response.
Exactly. This shows our understanding of fairness goes way beyond simple economic principles of maximizing profit. The perceived intentions behind an action and the broader context matter hugely.
Does context change things?
Definitely. For instance, if we tweak the scenario slightly, say it was auctioning off a popular collectible doll, and we added that the extra profits would be donated to UNICEF.
Okay, a charitable motive.
Right. The level of perceived fairness for a price increase in that context rose considerably. People found it much more acceptable.
But even charitable intent doesn't always make price increases okay, does it? I remember the example of essential goods like flu medicine during an epidemic.
That's a critical distinction. Auctioning off the very last available package of flu medicine in a town severely hit by an epidemic was still considered unfair by most people, even if the proceeds were going to charity.
Why the difference?
It seems essential goods and services, particularly in times of crisis or need, fall into a different moral or mental category than discretionary items like dolls.
Right. Life-saving medicine versus a toy.
Exactly. And this also connects to the broader societal resistance we see globally to completely free markets in certain domains, like human organs, with Iran being a really interesting exception there. Fairness is clearly about much more than just the final economic outcome.
So, what might seem like a perfectly reasonable business decision based on market forces can be perceived as deeply unfair by customers or even employees. And that could have significant real-world consequences for businesses, couldn't it?
Oh, absolutely. First Chicago Bank experienced this firsthand.
What happened there?
They tried to encourage ATM usage, probably to cut costs, by implementing a fee for using human tellers for services that could be performed at an ATM.
Okay, seems logical from the bank's perspective.
Maybe. But customers reacted with fury. They saw it as unfair, nickel and diming them. It led to terrible press, damage to the bank's reputation. It backfired badly.
So it underscores the importance for businesses to consider not just their own economic logic, but also how their customers are likely to perceive the fairness of their actions.
Exactly. It's a powerful reminder that understanding these psychological nuances is crucial for operating effectively and maintaining positive relationships.
Okay, let's touch on cooperation. What does behavioral economics tell us about why we choose to cooperate, or why cooperation sometimes breaks down?
Well, traditional economic models, based on pure self-interest, often predict that cooperation will decline in repeated interactions.
Because people learn it pays to be selfish.
Kind of. As individuals rationally learn that pursuing their own self-interest, like not contributing to a public good, can lead to better personal outcomes, cooperation should unravel.
But is that what always happens?
Experiments involving public goods games show a more complex reality. While cooperation often does decrease over repeated rounds, just as the theory predicts, James Andreoni's research introduced a fascinating twist.
What did he do?
He had the same groups of participants continue to play additional rounds after that initial drop in cooperation had occurred.
And what happened? Did it stay low?
No. He observed a significant rebound in cooperation. People started cooperating more again.
Huh. Why would that happen if they had already learned to be selfish?
It suggests that factors beyond just simple learning about pure self-interest are at play. Maybe things like reciprocity, trust, or social norms kick back in. It's not just cold calculation.
Yeah. So it's not just individuals coldly calculating the most selfish strategy. There's something else influencing our willingness to cooperate.
Exactly. And speaking of behaviors that deviate from purely rational self-interest, let's revisit the endowment effect with that famous mug experiment.
Ah, the mug. Yes, tell us about that one. I know it's a classic.
It really is. In this experiment, we took a group of students and randomly divided them into two groups.
Okay.
One group, the sellers, were given a university-branded coffee mug.
Yeah.
You know, that kind of the campus bookstore sells.
Right. Free mug.
The other group, the buyers, didn't get a mug. Both groups were allowed to look at and handle the mugs.
So everyone knew what the mug was like.
Yep. Then we set up a market. Sellers could indicate the lowest price they'd be willing to accept to sell their mug. Buyers could indicate the highest price they'd be willing to pay to buy one.
And what would standard economic theory predict?
Standard theory, assuming mugs are just mugs and people value them based on some objective market price, would predict that about half of the mugs should trade hands. Random allocation, so roughly half the people who got one, would value it less than half the people who didn't.
Okay, lots of trading expected. But the prediction based on the endowment effect was different.
Yes. We predicted significantly fewer trades would actually occur.
Why?
Because those who own the mugs, the sellers, would value them more highly simply because they possess them.
Compared to the buyers who didn't own one yet.
Exactly. Compared to the value placed on the identical mugs by the potential buyers. Their selling price would be higher than the buyer's buying price, on average.
And what did the results show?
The results, across multiple rounds and variations of the experiment, consistently confirmed our prediction. The market for mugs was much, much less active than standard theory expected. Far fewer trades happened.
Providing strong evidence for the endowment effect in action.
Really strong evidence. People demanded roughly twice as much to sell their mug as others were willing to pay to buy one.
All of this accumulating evidence of systematic deviations from rationality. It must have led to some interesting debates, maybe even confrontations within economics.
Oh, definitely.
The conference held at the University of Chicago sounds like it was a particularly significant event in that regard.
It was quite remarkable, yes. Holding a conference focused specifically on behavioral economics at the University of Chicago.
Which was kind of the stronghold of rational choice theory.
Exactly. It was often seen as the intellectual heartland of rationalist economics. So holding it there was in itself a statement.
So it was like rationalists versus behavioralists.
It essentially became a very public debate between the established rationalist guard and the younger group of behavioral economists. You had key figures like Robert Lucas, Merton Miller, Gene Fama representing the traditional view.
And Nobel laureates.
Right. And then researchers like Bob Shiller, Richard Zeckhauser, and myself presenting the behavioral perspective. And Kenneth Arrow, another Nobel laureate, was actually quite supportive of the younger group.
Wow. What was the atmosphere like?
The auditorium was packed. The discussions were lively, shall we say, intense at times.
I bet. With such strongly held opposing views.
There were certainly some strongly held opinions, actually, to try and preempt some of the predictable criticisms that were often leveled against behavioral economics.
Yeah.
I even put together a sort of tongue-in-cheek list of heresies for the conference handbook.
A list of heresies, like what?
Just outlining the common objections we always heard, along with our brief responses. Things like, Objection 1, if the financial stakes are high enough, people will behave rationally. Or, Objection 2, in the real world, people learn from their mistakes.
So you were anticipating the pushback and trying to address it proactively, like an FAQ for behavioral economics critics.
Exactly. It was partly that. This period also made me think more deeply about Thomas Kuhn's model of scientific revolutions.
Paradigm shifts.
Yeah. He argued that paradigm shifts in science happen when the number of anomalies, things the existing paradigm just can't explain, becomes too large to ignore.
And you saw behavioral findings as those anomalies for standard economics.
I did. Although I was still relatively early in my career, maybe a bit hesitant to explicitly frame our work as a full-blown revolution in economics just yet.
More like adding psychology to the mix.
My underlying goal was really to demonstrate that incorporating insights from psychology into economic models was a necessary and valuable step forward. It wasn't about throwing everything out, but about making economics more realistic.
And to help push that forward, you started that anomalies column.
Yes, in the Journal of Economic Perspectives, a quarterly column specifically focusing on these empirical puzzles and anomalies in existing economic theory.
That column became really influential, didn't it? A platform for highlighting these inconsistencies.
It seemed to have some impact, yes, but it wasn't always straightforward to write.
What?
Well, it was incredibly time-consuming. I often had to delve into areas of economics or finance. I wasn't deeply familiar with like insurance markets or specific financial instruments.
So you had to learn a lot for each column.
A huge amount. Because of this, I've frequently collaborated with co-authors who were specialists in those particular areas. But I always made sure to really learn the material and write the final versions myself after a significant amount of background work.
Sounds like a big commitment.
It definitely took time away from more traditional research projects, publishing in standard journals. But the potential to influence the direction of mainstream economics to get these ideas out there made it feel worthwhile.
And you mentioned needing support early on.
Oh, absolutely. None of this early progress, the conferences, the research, would have been possible without the crucial early support of Eric Warner at the Russell Sage Foundation.
He was a key funder.
He really was a foundational figure in providing funding and, just as importantly, legitimacy to behavioral economics research when it was still very much on the fringes. His support was invaluable.
It's fascinating, circling back to biases, how even those who study them deeply can still be susceptible. You mentioned the anecdote about Danny Kahneman after Amos Tversky's death.
Yes, with the book introduction.
Finishing the introduction to their book took much longer than expected, right?
Much longer. Even though Danny himself was instrumental in identifying and describing the planning fallacy or the inside view bias.
Our tendency to underestimate how long tasks will take.
Exactly. Even when we have relevant past experience of similar tasks taking longer. He knew about the bias intellectually, but in that deeply personal and difficult situation of working on their joint project after Amos's passing, he still found himself falling prey to it.
It shows how powerful these biases can be, even when we're aware of them.
It really does. We're all human.
Now, let's explore some of the specific big economic puzzles that behavioral economics has helped to solve, or at least shed significant new light on. The equity premium puzzle is a major one in finance.
It is indeed a real classic. The equity premium puzzle refers to the historically large difference in returns between stocks, equities, and much safer investments like government bonds.
Stocks have just done way better over the long run than bonds.
Way, way better. Much more than you would expect just based on their extra riskiness, according to standard financial models.
Who first pointed this out?
Economists Rajneesh Mehra and Edward Prescott published a famous paper showing that standard economic models, based on rational investors and their aversion to risk, simply couldn't account for the magnitude of this premium.
They couldn't make the math work.
Not without assuming levels of risk aversion that seemed implausibly high. Like, people would have to be ridiculously scared of tiny risks to demand such a huge extra return for holding stocks.
So the observed returns on stocks have been much higher than what traditional financial theory predicted. How did behavioral economics approach this?
Well, my colleague Shlomo Benartzi and I looked at it through the lens of two key behavioral concepts: loss aversion.
The idea that losses hurt more than equivalent gains feel good.
Right. And narrow framing.
What's narrow framing again?
It's the tendency to evaluate individual investments or decisions in isolation rather than looking at them as part of your overall portfolio or overall set of choices.
Okay, so focusing on each bet separately.
Exactly. Paul Samuelson had actually famously criticized a colleague for exactly this. The colleague turned down a single, very attractive gamble with positive expected value.
Because he might lose.
Yeah, because there was a chance of losing on that one bet. But Samuelson pointed out the colleague was simultaneously accepting many similar, smaller, but still positive expected value bets in his daily life or investment portfolio.
And Samuelson said the mistake was?
We argued, building on Samuelson, that the mistake wasn't necessarily in accepting the multiple bets collectively. They offered a high probability of gain. The mistake, from a purely rational view, was rejecting the single attractive bet due to a narrow focus on the potential for a loss on that specific gamble.
Okay, I see. So how does this relate to the equity premium?
This leads to the concept we called myopic loss aversion.
Myopic meaning short-sighted.
Yes, it's a combination of focusing frequently on short-term gains and losses, myopia, and the heightened sensitivity to those potential losses, loss aversion.
And that makes people shy away from stocks.
It can make people overly cautious about investing in potentially high return, but also more volatile assets like stocks, especially if they check their portfolio performance frequently. They see the ups and downs, feel the pain of the downs more acutely, and demand a very high premium to compensate for that short-term volatility risk.
Even if stocks are likely to do well long-term.
Even if, over the long run, stocks have historically provided much higher returns.
Did you test this idea?
Yes. We conducted an experiment with employees at the University of Southern California regarding their choices in their 401k retirement plans.
What did you show them?
We presented them with historical returns data for two hypothetical funds: a riskier fund with a higher average return, like stocks, and a safer fund with a lower average return, like bonds. Crucially, we didn't label them stocks and bonds.
Just Fund A and Fund B.
Essentially, yes. The key element was how frequently the returns were evaluated and presented to the participants.
So did you show some people annual returns and others, say, 20-year returns?
Exactly. We showed different groups, different charts depicting the historical distribution of returns over different time horizons. Some saw year-by-year fluctuations. Others saw smoothed-out long-term average returns.
And what did you discover? How did it affect their investment choices?
We found that when the investment returns were evaluated and presented more frequently, like showing the ups and downs every year, participants showed a much stronger aversion to the riskier fund.
Because they saw the losses more often?
Presumably because they were more likely to see and react emotionally to those interim losses. However, when the exact same underlying return data was presented over a much longer time horizon, showing the smoother long-term growth,
What happened then?
participants were significantly more willing to allocate more of their money to the riskier, higher return option.
Wow, so just changing the presentation frequency changed their risk tolerance.
It provided strong support for the idea that a myopic focus on short-term market fluctuations, combined with loss aversion, contributes significantly to why people demand such a high premium for holding stocks.
That makes perfect sense. The more often you check your investment portfolio, the more likely you are to see a dip, and that feeling of potential loss can be much stronger than the anticipation of a future gain. Now, this tendency to focus on the short term and react to losses, it can show up in some unexpected places too, right? Like the behavior of taxi drivers.
Yes, that's another fascinating study. Research on New York City cab drivers done by Colin Kammerer and colleagues found a seemingly irrational pattern in their work habits.
What did they do that was irrational?
They tended to work fewer hours on days when fares were high, like good weather, lots of customers, high hourly wage potential.
And work more hours when business was slow.
Exactly. They worked longer hours on days when fares were low, meaning their hourly earnings were lower. This is the opposite of what standard economic theory would predict.
Right, you should work more when the pay rate is high.
Precisely. Maximize your income. So why were they doing this?
What's the behavioral explanation?
One potential explanation is a form of narrow framing combined with loss aversion, specifically relating to income targeting.
Daily income targets.
Yeah. Drivers may set a specific daily income target in their mind, say $300 for the day.
Okay.
Once they reach that target on a high-wage day, maybe they reach it quickly, the incentive to continue working diminishes sharply. They've secured their gains for the day, met their goal.
And on slow days?
On low-wage days, they might feel compelled to work longer and longer hours, chasing that $300 target, trying to avoid the feeling of loss or falling short of their mental benchmark for the day.
Even if it means working inefficiently long hours for low pay.
Exactly. Interestingly, the study also found that more experienced drivers tended to exhibit more economically rational behavior working longer on good days. So maybe there's some learning over time.
But the key insight is that focusing on short-term goals, like daily earnings targets, and avoiding the feeling of falling short can lead to decisions that aren't optimal in the long run for maximizing income.
Precisely. It's another example of narrow framing, focusing on daily earnings instead of weekly or monthly income.
Okay. Now, all of this discussion about market anomalies, myopic loss aversion, cab drivers, it naturally leads us to the efficient market hypothesis, the EMH.
Well, yes, the cornerstone of traditional finance for a long time.
What exactly is the EMH, and how does behavioral economics challenge its core ideas?
Well, as you summarized earlier, the efficient market hypothesis essentially has two main related components.
Right. Prices are right, and you can't beat the market.
Basically, yes. The first component, often called price efficiency or summed up as the price is right, suggests that asset prices like stock prices accurately reflect all publicly available information at all times.
So they always trade at their true intrinsic fundamental value.
That's the strong claim. Cliff Smith at Rochester used to say it very enthusiastically. The price is right.
And the second component follows from that.
Yes. If prices already reflect all information, then it's virtually impossible for investors to consistently beat the market and achieve risk-adjusted returns above the average, except maybe through luck or inside information. This is the no free lunch part.
Okay. So how does behavioral finance challenge this?
Behavioral finance challenges both components by identifying numerous market anomalies, persistent patterns in asset prices, or investor behavior that seem inconsistent with market efficiency and rational actors.
Like the results that Buta contest game you mentioned the Financial Times used to run. That seems relevant here.
It is a perfect example of how thinking deviates from perfect common knowledge rationality, which underpins the EMH.
Remind us how that worked again.
Participants had to guess a number between 0 and 100. The goal was to choose the number that was closest to 2/3 of the average guess of all participants.
Okay, so you have to guess what everyone else will guess, then adjust.
Exactly. Now, if everyone were perfectly rational and knew everyone else was perfectly rational and so on, the Nash equilibrium, the logical outcome, is 0.
0? How?
Well, the average can't be above 100, so 20/3 can't be above 67. So no rational person guesses above 67. But if everyone knows that, no one guesses above 23 of 67, which is 44. Keep iterating that logic.
And you end up at 0.
Right. But what actually happened in these real-world games? The winning guesses were typically around 13 or so.
Not 0. Why?
It demonstrates multiple levels of strategic thinking. Some people guess randomly. Some guess 50, average 23 equals 33. Some guess 33, 23 equals 22. Others try to anticipate that level of thinking. People are trying to outsmart each other, but not perfectly, leading to outcomes far from the purely rational prediction.
And people gave explanations for their guesses.
Oh yeah, and they were fascinating, ranging from complex game theoretic reasoning down multiple levels to surprisingly simple heuristics like picking a lucky number or even just misunderstanding the rules.
So it highlights that market behavior isn't always driven by purely rational actors processing all information perfectly and anticipating others doing the same.
Exactly. Market participants aren't just reacting to underlying fundamentals. They're also reacting to and trying to anticipate the behavior, maybe even the irrational behavior, of other participants.
It kind of reminds me of John Maynard Keynes' famous line.
In the long run, we are all dead.
Yeah. That seems particularly relevant for professional portfolio managers who often operate on much shorter time horizons than the theoretical long run of economic models. They might care more about short-term performance relative to peers than long-term fundamental value.
Absolutely. Their incentives might push them towards momentum trading or following the herd, even if they suspect prices are deviating from fundamentals.
And this idea that our thinking isn't always perfectly rational and forward-looking, it has big implications for market forecasts and asset valuations too, right? You tried to use a Kahneman and Tversky finding about predictions.
Yes, we did. We attempted to use a well-established finding from their psychology work, specifically about how people make predictions based on limited information, to predict something previously unknown about financial markets that would contradict efficient market beliefs.
What was the finding about predictions?
In their psychology experiments, K&T found that if people were given quite limited but extreme information about someone, like being told a student was in the top 10% or bottom 10% of their class based on GPA, they tended to make similarly extreme forecasts about that student's future academic performance, often overweighting that initial, maybe flimsy piece of information and neglecting regression to the mean.
So they'd predict the top 10% student would stay in the top 10%.
Often, yes. Making predictions that were too extreme given the limited predictive power of the initial data point. We hypothesized that similar dynamics might be at play in financial markets,
Leading to overreaction.
leading to overreactions to limited but dramatic news or recent performance data, maybe driving prices too high after good news or too low after bad news.
And this connects to the long-standing debate about value investing, doesn't it?
It does. Benjamin Graham's strategy of identifying and investing in stocks that seemed undervalued based on fundamental metrics like low price-to-earnings ratios,
That seemed to consistently outperform the broader market over long periods.
which, according to the efficient market theory, shouldn't really be possible consistently, beyond maybe accounting for higher risk.
Did academic studies back this up?
Yes, studies by Sanjoy Basu and later Rolf Banz provided empirical support. Basu found value stocks tended to outperform. Banz found that small capitalization firms tended to generate higher returns than predicted by standard risk models, like the CAPM.
But they didn't declare the market inefficient.
Well, the conclusions of these early academic studies were often somewhat hesitant. They might suggest these anomalies could be due to limitations in the risk adjustment models or maybe data mining, rather than definitively stating the market was inefficient.
Kind of apologetic.
A little bit. In contrast, actual value investors like David Greman were much more assertive in their claims that Graham's value investing approach clearly demonstrated market inefficiency and exploitable mispricings.
So it illustrates how the implications of empirical findings can be interpreted differently depending on your starting beliefs about market rationality.
Absolutely. There was real resistance within mainstream finance to readily accept findings that seemed to contradict the bedrock principle of the EMH.
Which is why things like that behavioral finance workshop you started with Bob Schiller were important.
Yes, the establishment of the semi-annual NBER Behavioral Finance Workshop by Bob Schiller and myself was really key. It provided a dedicated, respected platform for researchers exploring these apparent anomalies and helped to gradually build legitimacy and momentum for the field.
And sometimes these market anomalies were just really striking and hard to explain away by traditional theories, right? Like the Palm Pilot IPO example.
That was a particularly illustrative, almost absurd example of potential mispricing.
What happened there? This was back in the dot-com boom.
Yes, peak dot-com mania. The company 3Com decided to spin off its Palm division, which made the popular Palm Pilot handheld organizers.
Okay.
They sold off a small percentage of Palm shares in an IPO, but retained ownership of the rest. For a while, you could buy shares in Palm directly, or you could buy shares in the parent company, 3Com, which owned most of Palm plus all of its other businesses.
So the value of 3Com should have been higher than the value of just its Palm stake.
Logically, yes. Since 3Com owned about 1.5 shares of Palm for every share of 3Com, plus its other profitable businesses, 3Com's price should have been significantly higher than 1.5 times Palm's price.
But it wasn't.
For a period, it wasn't. The market value of the Palm shares owned by 3Com was actually higher than the total market value of 3Com itself. This implied the market was assigning a large negative value to all of 3Com's other established profitable businesses.
That makes no sense. How could that happen?
It was a clear arbitrage opportunity, but there were frictions making it hard to exploit quickly. It seemed the market was just valuing Palm based on the incredible hype and narrative surrounding sexy new tech companies at the time, ignoring the fundamental arithmetic.
Suggesting a degree of irrational exuberance driving prices way off fundamentals.
Exactly. It strongly suggested that market valuations can sometimes be driven by psychology, by stories, by momentum, more than just a rational assessment of underlying value.
It definitely makes you question the idea that market prices always perfectly reflect intrinsic value. Now, even within finance, there were different views on how efficient markets were. Fisher Black had a more nuanced take.
He did. Fisher Black, a brilliant and highly respected financial economist, famously quipped that he thought market prices were generally right within a factor of 2.
Meaning they could be off, but not wildly off, maybe double or half the true value.
Yeah, acknowledging some degree of noise or temporary mispricing, but still suggesting a relatively high level of efficiency overall. Prices weren't perfectly right, but they weren't crazy wrong either, in his view.
But do major market events challenge even that view?
I think so. Events like the dramatic rise and subsequent collapse of the U.S. housing bubble in the mid-2000s or the dot-com crash earlier.
Prices seem to go way beyond a factor of 2 off any reasonable estimate of intrinsic value then.
It certainly seemed that way to many observers. These episodes demonstrated, I think, that market prices can sometimes become very wrong, disconnected from fundamentals by much more than a factor of 2, driven by bubbles and crashes.
It certainly challenges the strong form of the EMH, and maybe even Black's more relaxed version. Now, behavioral economics hasn't just stayed within finance. It's extended its reach into other fields, too, like law and public policy.
Absolutely. That's been a really exciting development. Cass Sunstein and Christine Jahls were pioneers in explicitly applying the principles of behavioral economics biases, heuristics, framing effects to the analysis of legal rules and policy decisions.
Looking at how real people, not just econs, might respond to laws.
Exactly. Their work, however, sparked significant debate and faced pretty strong opposition from those adhering to the traditional law and economics perspective.
Which heavily relies on the assumption of rational actors.
Heavily. Figures like Judge Richard Posner were prominent critics, arguing from that traditional viewpoint.
Was there a dynamic in those early debates?
Sometimes in the early discussions, the economists' often more formal mathematical training sometimes gave them a perceived advantage, or at least a different language, in these interdisciplinary debates with legal scholars.
But the behavioral insights offered a new lens for law and policy.
A really valuable new lens. For instance, take the Coase theorem.
What's that again?
In law and economics, it basically posits that if there are no transaction costs as bargaining and making deals, then the initial allocation of property rights doesn't matter for efficiency. Parties will bargain to reach the most efficient outcome, regardless of who starts with the right.
Okay, a foundational idea.
Yes, though Coase himself acknowledged the crucial caveat about the unrealistic assumption of zero transaction costs. But behavioral economics added another layer.
How?
Our mug experiments, even in a setting designed to have virtually zero transaction costs,
Showed the endowment effect mattered.
exactly. They show that the endowment effect, our tendency to value what we own more highly just because we own it, could prevent efficient trades from happening, even with minimal transaction costs.
So the initial allocation did matter for the final outcome.
It mattered significantly for the final allocation of mugs, contradicting the Coase theorem's prediction when goods have subjective value and psychological ownership kicks in.
So it illustrates how behavioral biases can have real-world implications for the effectiveness of legal and policy frameworks that are built on those assumptions of perfect rationality.
Definitely. If laws assume people will bargain costlessly and rationally based on objective values, but they don't because of the endowment effect, the law might not achieve its intended efficient outcome.
It makes you wonder, that resistance you mentioned earlier to behavioral economics from those deeply invested in the rational actor model,
Yeah.
could it itself be a manifestation of the sunk cost fallacy?
That's a very insightful and provocative thought. Being unwilling to abandon a theoretical framework they've invested so much time and intellectual energy in developing and defending.
Even if anomalies keep piling up.
It's certainly possible. And it's a good reminder that we're all susceptible to cognitive biases, regardless of our field or expertise. It's hard to escape our own psychology.
Another piece of experimental data that often comes up is the ultimatum game. That also shows deviations from pure self-interest, right?
Yes. The ultimatum game provides compelling data
Mm.
showing that people don't always behave in a purely self-interested, maximizing way, especially when issues of fairness come into play. People will reject offers they perceive as unfair, even if it means getting nothing.
Okay, let's bring this into the world of sports for a moment because it's a great real-world lab. Your involvement with the Philadelphia Eagles and analyzing the NFL draft is a fascinating example.
It was a really interesting experience, yes. We actually set up an internal office draft, sort of a mock draft based on the predicted order of the actual NFL draft picks.
Just for fun within the team?
Yeah, but people got really into it. There was a lot of initial excitement about getting the early picks, the top selections, but then things got a bit chaotic when some player measurements or evaluations changed unexpectedly right before the real draft.
And people wanted to change their picks.
Some participants wanted to trade or change their selections based on this late news. It got me thinking more deeply about how NFL teams themselves value these draft picks. Does the conventional wisdom that early picks are incredibly valuable actually hold up?
Or could there be a form of market inefficiency, maybe an overvaluation of those early picks?
Exactly, violating the efficient market hypothesis in a sense.
Uh,
So we decided to analyze historical trade data. Teams trade draft picks all the time.
right, trading up for a higher pick or trading down for more picks.
Precisely. We used the data from decades of these trades to try and estimate the relative market value teams implicitly placed on picks in different positions.
And what did that analysis reveal about the perceived value?
Our analysis suggested a very steep value curve. The first overall pick is perceived in these trades as being worth significantly more than even the second or third pick, and the value dropped off really sharply in later rounds. Teams paid a huge premium to move up just a few spots at the very top.
Okay, so the market thought early picks were massively valuable, but what about their actual performance?
That was the next step. We looked at the actual on-field performance of players drafted at different positions and in different rounds over many years, using various metrics.
And did the performance match the perceived value?
Not really. We found that even the highly coveted first overall pick only had roughly a 50% chance of turning out to be among the top half of players at their position in the league, let alone being a superstar.
Only 50-50 for the very first pick. That seems low given the hype.
It highlights the huge amount of uncertainty involved. It suggested that the very high price teams paid in trades for those early picks might not be fully justified by the actual probability of drafting a truly elite, game-changing player.
So a potential overvaluation may be driven by hope or overconfidence in scouting abilities.
Possibly. Maybe based on hope, maybe the winner's curse in bidding for picks, maybe overconfidence, maybe focusing too much on finding that one superstar. It indicated a potential market inefficiency driven by psychological factors.
So even in a high-stakes professional environment like the NFL draft, with teams investing millions in scouting and analysis, decisions might still be heavily influenced by biases and an overestimation of predictability.
It certainly seemed that way. Now, you've also looked at evidence from game shows, right? As another way to study decision-making when real money is on the line.
Why game shows?
Well, game shows offer this unique kind of real-world laboratory. Participants are making decisions, often under pressure, with potentially large financial consequences.
So it counters the criticism that lab findings with small stakes don't apply.
Exactly. While it can still be challenging to perfectly isolate specific behavioral causes, unlike in a controlled lab experiment, game show settings often provide a clearer environment than, say, complex financial markets to test predictions from prospect theory, risk aversion, or other behavioral concepts.
Because the rules are clear, the stakes are explicit.
Right. You can observe people making choices involving real money, sometimes life-changing amounts, in a structured setting. It provides a valuable bridge between the highly controlled lab and the messy reality of markets.
Okay. Now, the application of behavioral economics has moved beyond just understanding how we make decisions. It's also being actively used to try and improve outcomes, right? Through the use of nudges in public policy.
Absolutely. That's been one of the most impactful developments in recent years. Nudges are interventions that aim to gently guide people towards making better choices for themselves.
Without forcing them or restricting their freedom.
Exactly. Without banning options or imposing mandates. The Save More Tomorrow program is a prime example.
How does that work?
It's a retirement savings plan designed by Shlomo Benarsi and myself. It utilizes automatic enrollment you're in unless you opt out. And, crucially, automatic escalation of savings contributions over time, usually timed with pay raises.
So it uses inertia and loss aversion to help people save more.
Precisely. It leverages people's tendency towards inertia, sticking with the default, and links savings increases to pay raises, so people don't feel the loss in their take-home pay as much.
And has it been successful?
Extremely successful. Studies have shown that these automatic features have been far more effective in dramatically increasing retirement savings rates, especially for lower and middle-income workers, than traditional approaches like just offering tax incentives alone.
So the architecture of the choice matters more than the tax break.
Often, yes. One study attributed the vast majority of increased retirement savings in recent decades to the adoption of automatic features, not changes in tax subsidies. The key insight is that subtle changes in how choices are presented and structured can have a massive impact on behavior.
And the power of defaults is another really clear illustration of this, isn't it? Like with organ donation.
Oh, a classic, powerful example. Organ donation rates differ dramatically between countries based purely on the default option.
Opt-in versus opt-out.
Exactly. Countries where citizens have to actively sign up to become organ donors, opt-in, generally have very low donation rates.
Like the U.S., historically.
Right. Whereas countries where citizens are automatically considered organ donors unless they explicitly choose to opt out, presumed consent.
Like Spain or Austria.
Yes. They have dramatically higher donation rates, often approaching 90% or more.
Wow. Just changing the default question.
It's a stark difference, highlighting the incredible power of the default option on our decisions, even for something profoundly important like organ donation. Inertia is incredibly strong.
And governments are actually setting up teams now to apply these insights, right? Like the Behavioral Insights Team or BIT in the UK.
Yes, the BIT in the UK was really a pioneer in this area, formally bringing behavioral science into government policymaking.
What kind of things do they work on?
A huge range of issues, from improving tax collection rates, encouraging healthier eating, reducing energy consumption, getting people back to work faster. Key figures like Rohan Silva in the Prime Minister's office and David Halpern, who led the team, were instrumental.
And they ran actual experiments, like randomized controlled trials.
Yes, a big part of their approach was rigorous experimentation, often using RCTs to test which interventions actually worked.
Even with something seemingly mundane like tax reminder letters.
Absolutely. They conducted a famous series of experiments with HMRC, the UK's tax authority, to see if they could improve tax payment rates simply by altering the wording of reminder letters sent to late payers.
What kind of wording changes worked?
One particularly successful intervention involved adding a simple, truthful sentence stating that the vast majority of people in their local area had already paid their taxes on time.
Using social norms. Everyone else is doing it.
Exactly. Appealing to social norms. This simple message led to a statistically significant increase in tax payments, several percentage points higher than the standard letter, boosting government revenue by millions of pounds at virtually zero cost.
That's amazing. Such a small change, such a big impact.
It demonstrates the cost-effectiveness and potential power of applying these simple behavioral insights to even seemingly routine administrative tasks.
And it's not just about complex financial matters, right? You mentioned simple text message reminders, too.
Exactly. These nudges can be very gentle and transparent. Programs like Ready AE 4K use simple text message reminders with tips for parents to encourage more engagement in their preschool children's literacy development.
And that works, too.
Studies show it leads to measurable improvements in school readiness. It just makes it easier for busy parents to act on their good intentions to help their kids learn.
So the crucial element in applying behavioral science effectively, whether in government or business, seems to be experimentation.
Absolutely. A commitment to experimentation and a willingness to learn from the results, test what works and what doesn't, even if the initial design isn't a perfect academic RCT.
Because real-world settings are messy.
Exactly. Running pure randomized controlled trials can be challenging sometimes due to political or practical constraints. But the effort to test and refine interventions based on behavioral principles is essential for making real progress.
It's also interesting to see how these micro-level insights about individual behavior are starting to influence macroeconomics, too, like how governments design tax cuts.
Yes, that's an emerging area.
Yeah.
Behavioral macroeconomics suggests that the way a tax cut is designed and delivered.
Lump sum versus spread out.
For example, whether it's given as a single lump sum check or spread out over multiple smaller payments deducted from paychecks, that can significantly impact its effectiveness in boosting consumer spending.
Why? Because of mental accounting again.
Likely due to mental accounting and how people tend to treat windfall gains, lump sums might be saved or used for debt, versus changes in regular income, smaller increments might be more readily spent. Spreading it out might be more effective for stimulating immediate spending.
It really highlights how a deeper understanding of human psychology is becoming increasingly crucial for developing more effective policies across a huge range of economic and social domains.
Absolutely. The field of behavioral economics has come a very long way from those early days of skepticism. There's increasing acceptance, much more rigorous empirical testing of its theories in diverse fields.
And the methods are changing too.
The growing use of randomized controlled trials, field experiments throughout economics reflects this shift. We're moving beyond relying solely on monetary incentives as the assumed drivers of behavior and increasingly incorporating insights from psychology, even neuroscience, to build more accurate and predictive models of human decision-making.
So, as we wrap up this deep dive, it seems really clear that to truly understand economic behavior, we absolutely need to look beyond that traditional assumption of perfectly rational actors, the econs.
We really do.
We need to embrace the sometimes messy, often surprising, but ultimately very human psychology that underlies our choices.
Well said.
From the seemingly small impact of how exam points are framed, to the large-scale effects of default options in organ donation, and from the way we value a free basketball ticket based on whether we own it, to the design of more effective tax policies or retirement plans. Understanding these behavioral nuances provides a much richer and frankly more accurate picture of how the world actually works.
It really does. It moves economics closer to reality.
It certainly gives you, the listener, a lot to think about in terms of your own decision-making, doesn't it? Whether it's in your personal finances, your career choices, or even just your everyday interactions and how you might perceive fairness or risk.
Indeed. There's a whole world of fascinating insights to uncover once you start viewing decisions, both your own and others, through this behavioral lens.